we have the market overall, the S&P 500 is down around 10%, Nasdaq's off around 15% in a drawdown territory. So clearly a pretty big shift in risk appetite over the last couple of weeks. Like I just mentioned, it feels like ages ago we talked about fart coin when animal spirits were really taking over the market. And I think on this podcast, you expressed your level of, feeling a little bit uneasy as fairly high. Now, we're not going to let that dictate all of the investment decisions, still allocating into exciting companies, but not entirely surprising that we've had a little bit of a shift in risk appetite from what seemed like a big appetite for risk. Doesn't mean it's not painful to go through these periods of decline, but before we get in the portfolio, where's kind of your head at in navigating the headline grabbing things like all the tariffs, everything coming out of DC? How do you sort through that and then look at the companies in the portfolio? So just where's your head at in general right now?
Yeah, David. So I think the past couple weeks from when we last recorded a podcast for everyone, it has taken this sell-off from, well, these things happen to something that is genuinely historic. As of Thursday, there's been 16 straight days with an intraday 1% decline in the Nasdaq 100. We are recording on Friday. As of right now, the market looks pretty good. We could break that streak, but who knows? Maybe we'll see some tariffs on pig futures or something like that. The streak will continue. So that's one aspect. The second aspect is how steep this decline's been. The Nasdaq composite fell by about 12.5%, 13 trading days. As you know, I believe it's down about 15% overall. That is almost exactly the decline at the start of COVID. So if you think back to how things felt at the start of COVID, this decline is now matching it almost exactly. And specifically for AI stocks, there was already kind of a bear market moment before this with DeepSeek. Now, we look at another key metric, which is if this does turn into a bear market, which it's not, you need to go down 20% to be officially a bear market. It would be the first time since World War II that we've seen 3 bear markets in 5 years. So as much as the environment's been good, this would be the most historic compression of some really volatile markets. Another couple facts I think are worth bringing up, just, David, to talk about the overall market. This week, barring something truly phenomenal today, like a 6% gain, which, spoiler alert, will not happen, will be the 5th consecutive decline for the Nasdaq. We haven't seen 5 consecutive weekly declines in almost 12 and a half years. And finally, every single Meg 7 stock is either in a bear market or within 1% of a bear market. So, David, I hope those kind of stats, they're not as fun as Fartcoin, but they kind of summarize the moment we're in today. That, again, it's gone from a little bit of, well, these things happen, to something that is, on a kind of decade basis in terms of severity, right?
Right. So you're saying, I think when you draw parallels to COVID, matching that decline is the difference there during COVID. I think we had some days where the market would be up 3% and then back down. This has just been pretty straight down. Is that why it just feels maybe not as chaotic as COVID, but you're saying it's still on par with that decline?
I think so. Specifically, we're looking the probably strongest index relative to the portfolio that we have would be the semiconductor, the SOX, you'd call it. And that's now off 27% from last summer. Specifically in this environment, too, we're seeing, because, as you said, it is continually a series of very strong down days. I mean, 16 days in a row with an intraday 1% decline. I don't know if that's never happened, but I'm pretty confident saying it's never happened before. It is, when you have a sell-off of that severity, it's going to be more of a risk-off situation, because one area, David, when we were expressing some unease with the gains that we were seeing so quickly, is often because stocks are re-rating. So, when you re-rate, you have really good earnings news and it kind of causes everyone to take estimates up. When you have the prospect of a recession coming, generally a lot of those stocks that re-rated is where you're taking those estimates back in. So you're kind of losing those gains extremely quickly. So, right now the portfolio, I look before we record, It's down by about 14%. It in a way, it feels even worse than that. It's partially because we had the big lead headed into that DeepSeek moment, but that doesn't feel tremendously inconsistent with the pain that we've felt in the market, which I know doesn't help people. But I believe, my personal portfolio, which, as we've discussed, the concept of this AI portfolio is not to be your entire portfolio. It's supposed to be a complement to other things that you're doing. I think it was down 6% when I looked at it the other day. So as much as this feels extremely painful, we also do need to remember this is on the back of extremely strong gains in early January as well. And overall, well, this has been hard to invest through. The totality of the drop still isn't comparable to some of the worst that we've seen in recent years.
I mean, recent years, you even go back to 2022. It feels like not an exactly similar environment, but a lot of the fears in 2022 were, if you go back to the beginning of that year, almost every economist on Wall Street was saying, we're going into recession, recession's happening. And then that's where you get the re-rating of stocks, which can then filter into company guidance, right? Companies become more conservative. They're going to take down their estimates, and you kind of have a, vicious cycle of maybe risk off negative feelings going towards the market. So you don't have to go back long. And we had such a strong recovery out of 2022. I think people do forget that how painful that year was. That was an extremely painful for, Mag 7 stocks. I think Nvidia was down, 60, 70%?
60 or 70%. Amazon was down a tremendous amount. I mean, Meta at the tail end of 2022, right? It had gone from, I think, something like $500 a share down to 80. I can't remember the exact numbers. Again, because advertising traditionally is one of the areas that sees the greatest weakness during recession. So, David, I think it's great that you bring up 2022, because at this moment when we're looking for comparisons and past history, last August, a lot of people forget about that. It was we've now passed the severity of that by most measures, but that was concern that the yen carry trade had imploded, and also interest rates were kind of back on the upswing. We saw basically a V out of that. In COVID, we saw a V recovery. In 2022, you really saw the sell-off begin in spring and March, specifically, a very painful period. But throughout the year, even into, late in the year, it was, as you mentioned, I think people discount how painful that year was now that we're past it and out of it. But into the late year, it was not as much a V. It was a little more of a continued process. One comp I've been thinking about in my mind as well is 1998, which, that's going very far back in time, and it's more being a student of history than having experienced it myself. But that was when we had a crash in long-term capital management. The book, When Genius Failed, profiles that, and the Nasdaq plunged 34% in the middle of kind of the ongoing internet boom. What was really interesting about that event was we moved past the panic fast enough that the kind of blistering rate of spend on the infrastructure build out for the internet didn't really pause. So a lot of the stocks went down by dramatic amounts. But since the spending on the end market was impacted coming out of it, you actually saw the most kind of furious gains, with a lot of stocks up 5 or 10-fold in, the next 18 months following that. So that's a comp when we're thinking about, well, since we've said the beginning of this podcast, we have no expectations of just up and to the right. And the penalty for seeing the best returns in a mega trend is that you're going to have to go through some harsh drawdowns. If it was free money, it would be free money, and free money does not exist, right?
Yeah.
So the question is, will we see something? If this turns into a harsher recession than expected, and it really does impact spending plans, I mean, this portfolio is going to outperform for a period. That's full stop. But if this recession doesn't materialize to the level expected, because it is kind of happening largely from uncertainty, right, caused by areas like tariffs, there's a good chance spending will continue unabated. As we'll get to shortly, the news recently has been very good in the space, and valuations, as we'll cover. I really wanted to look through valuations just to give people some perspective. And many of the stocks with the strongest growth in the space are trading significantly, in some cases, below market averages. So it's a very interesting time. I know, David, a little inside baseball here. We've been working in areas where we get to interface with customers and financial services for a long time. Generally, when people have the highest interest are when returns are the worst.
Right.
And I think we've seen podcast downloads drop by like 70% the past couple of weeks, or past couple months, I should say, from pre-DeepSeek. If you're listening today, I'm not saying this just to, try and get people still, love us still, but it is, you are above average just for doing that, because most people, they've already sold their stocks. They've already panic sold. They're already out of them. And if you are hanging on and continuing to invest, you are likely an above average investor. It doesn't mean that it's a certainty that we're going to outperform today. But as we look at the numbers, I think it's going to be very clear. This is actually a much better environment to invest in than we've had in the entirety, looking in the rear view mirror since launching this podcast. So, if you are engaged at this time that everyone's tuning out, and there's a law of measures, we can see it, investors are tuning out across the board, there's a good chance you're going to outperform from today.